Hi again, and welcome to another episode of the Upside Podcast, where we interview the most driven and ambitious investors and entrepreneurs in global emerging markets. Today, we have Mr. Avik Ashar, principal at Riverwalk Holdings, and he joins us from Bombay. Hello,
Hi, Kristie. Thanks for
how
having
are
me.
you doing? How's
Very
everything
well.
in Bombay?
Very well, very well. Monday kicking off the week. Quite fun.
Yeah, maybe to kind of start this off, I actually believe you're my first interview, like the first person I'm interviewing from India. So I think this is a good start for even the podcast as well. But you set out of Mumbai at Riverwalk. Maybe could you give us a bit of a background, like what exactly does Riverwalk do, and what you do there?
Sure. So Riverwalk Holdings is a really interesting firm. It's kind of the evolution of what a family office was and now has turned into a VC. We
Hmm.
started as the family office of the Thakral family, who's actually from Singapore. They're fourth generation Indians who've been operating across Singapore and Southeast Asia for the last 120 years. The family is mainly into real estate, distribution, and retail. Retailing Bose, Omega, Swatch Group, DJI drones,
Hmm.
Nespresso, and a whole bunch more across
Cool.
Asia, as well as a lot of real estate projects, specifically like an old age home chain in Australia, which just IPO'd, commercial real estate in Singapore and Japan,
Hmm.
and residential real estate in India.
Wow.
So the group's been operating in India for the last over 40 years. And
Hmm.
that's what kind of led to the creation of Riverwalk. The group across the last 1.5 decades kind of saw the the advent of startups in India and
Okay.
decided to participate in that growth. So they made 85 investments as a family across the past 15 years. And in 2022, the family realized that they had set up a very strong team. They really understood the Indian market and how to invest here in startups. But
Mhm.
the team was not going to be content staying with the family office for a much longer time. So
Hmm.
that's when the family decided to set up Riverwalk Holdings, named after the company's flagship in Singapore, Riverwalk.
Right.
And that's the origin of the name.
Wait, so when did they start? Like, when did their real exposure into startup investing begin? Did it begin as like investing in VCs and then slowly doing more directs, or have
Yes.
they always had this, experience of doing startups, like right from the very beginning, maybe from the US or something like that?
So it was a mixed startup, and it was a mixed start. So Satvir's father, Karan Singh Thakral, was actually part of the Dragon's Den, which was filmed about 15 years ago in Singapore.
Oh,
And from that time, they started investing first in Singapore into Singaporean startups, then ranging across to Southeast Asia, some in the US, and then with a large focus in India, since Satvir, the younger son from the family, was running the India and Indonesia business for the family. So he had a
right.
lot of access to companies in India. The family invested in 85 companies and seven funds. So that really
Mhm.
gave them a lot of learning, both on how to do direct investments, as well as what goes wrong sometimes in funds and how
Hmm.
funds can kind of make a few mistakes as they grow.
Hmm. What was there anything in particular that led you to, that drew you to Riverwalk? And I mean, you've also been investing even before you joined Riverwalk, right? Was there something in particular that you kind of liked about the way that they were approaching their investment strategy, and how different is it to the way that, you were previously doing investments?
Sure. So I really like the Riverwalk ethos. So and it stays very close to what I started off. So I
Mm,
started investing as a family office as well, working for a family office,
mm,
the Sutaria family, and that's when I met Satvir, and the two of us did a few investments together, which actually kind of cemented a friendship as well and a lot of trust.
mm,
When I saw how the Thakrals actually approached the thought process of investing, it was very first principles. It started with a very strong approach on founders who
mhm,
need domain experience.
mm,
So while with a lot of respect to younger founders, folks who come out of college and build companies, typically when you're building in Asia, in an area where like you've got a lot of you're building a lot for legacy businesses, you're building either for them, around them, for legacy industries, and you're
mhm,
solving a lot of early stage existential problems. It's pretty critical to understand your domain and really have expertise there. So we see two kinds of entrepreneurs thriving in this region. The
Mm.
first is folks who have built it at a smaller scale. Let's say someone who has a very small family business, but has spent time understanding the problems deeply from a
Mm.
family business aspect. Or the second
Mm.
is someone who's spent generally between about 7 to 10 years in the corporate side. And that's kind of the right balance where you've spent enough time, you've ideally taken up some level of leadership role, you've maybe moved one or two companies, and you've
Mm.
seen the problems that exist in your industry. And that gives you the right understanding of what it takes to solve them, as well as a network to make that happen. Where if you
Mhm.
need to pilot your solution, you can just call up colleagues of yours from or ex-colleagues of yours from other companies and get that pilot tested.
Mm.
So that part of the ethos is something that I share. The second part is that we take a very private equity approach to venture capital, which is, can we actually build our own theses? Can we understand where we see the market is going, what the market needs, and then
Mm.
can we go and find entrepreneurs who are building in that space? So it's
Mm.
less reactive. It's much less about waiting for companies to kind of land in our inbox, and more about building the thesis that we want to see being built, and then going out and looking for someone who's building it.
Is there any particular thesis that you're kind of looking at that is kind of interesting for you guys right now? And do you only focus on India right now, or do you kind of still look at other geographies?
So Riverwalk, when we took the call to start investing, we realized that investing is an extremely geographical specific
Mm.
activity, because the more you cement your name, the more you cement your brand, and the more you cement your understanding of a market, all of these compound. So trying to invest multi-geography right now when we're building it up is a bad idea. It makes more
Mm.
sense to be very geographical focused. So Riverwalk is an Indian fund registered with the regulator here, SEBI. So we invest only in India.
Okay. What about any particular, because you mentioned about finding a particular thesis and
So,
kind of,
so
yeah.
obviously I can't share the active thesis that we're currently contemplating, but I can share. One is I can share a broad thought process. So the
Mhm.
first is, when we're looking at what's needed, we're looking at the country and what we see the country needs in the next 10 years of growth. So when you're looking at India, we're kind of poised. Everyone, I mean, the world now is kind of looking at this country with a lens that this is India's decade, if not the next 2 decades for the country.
Yeah.
We have like, over a billion people, close to 1.4 billion people. There's a rising middle class, a huge amount of aspiration and ambition
Mhm.
in the country. And recently, there have also been some better moves in on the regulatory side to try and make it a little bit easier to build companies here, to be able to create here.
Mm.
So I think with all of this, we are looking at fintech, which is where our focus is: can there be financial inclusion? Can
Mhm.
fintech actually be channeled into productive pieces? So for me, a consumer loan to buy an iPhone is not a productive use of fintech. It's
Mhm.
definitely growing, but it's not a productive use. To allow a small to medium enterprise manufacturer to suddenly get access a loan to put solar panels on his roof and
Mhm.
defray his energy cost, as well as moving towards a certain amount of green. That is a great use of fintech. That is like how you build a win-win situation for everybody.
Mhm.
And funnily enough, that is a thesis that we actually pursued. And that's when we met the founders of a company called Aram Solar, which is someone who we backed even before they started the company formally, from our Riverwalk Fund 1. And in all likelihood, will continue to be supporting going forward.
How do you see competition for deals looking like in India these days? Because there's so much, allocation that's being kind of shifted away. Well, at least sitting out from Singapore, especially, I do see when I talk to a lot of the Southeast Asian funds, those that have been kind of cross-regional in focus now are kind of shifting the allocation more and more towards India. And when I talk to some of the Indian funds, they're also telling me like, yeah, it's actually really competitive because everyone's trying to put money into it. How do you see, competition look like these days? How is it shaping valuations, and how does it also kind of, how do you as a fund also differentiate yourself in the market when there's so much growing competition from all sides, from outside into India?
You've really hit the nail on the head. So, as you know, I moved back from Singapore after about 7 years living there, and a
Mm.
year after before that in Bangkok, so like 8 years in Southeast Asia. took the kind of decision to move back to India last year. And since I moved back, it almost feels like at least I don't miss my VC friends from Singapore. Everybody has landed up in India consistently. And while I really like it, because I think that India has always been capital starved, so more capital can help. My sincere plea, and I've told everyone this personally, so I'm happy to share it on a podcast, is don't spoil market.
Oh,
Come, but don't jack up valuations. Don't go crazy. Don't fund companies that should have. Don't keep on backing your companies that should have died. Uh, be a little bit more disciplined. What happened in Southeast Asia? Don't let's not replicate. Um,
are you
replicate.
concerned that that will happen? Because there does seem to be, a lot of allocation into India, but in the same breath, you're also saying that, oh, India seems under allocated for some reason.
It does. So I the one really good thing here is that our talent pool has seen a full cycle.
Mhm,
We had a lot of companies that started between 2005 to 2015 that today
mhm,
have a lot of them have gone IPO. A
mhm,
lot of them have become profitable, sustainable real businesses, which is, I mean, the goal of any startup. And
mhm.
you've had team members who've seen all the, if not the entire journey, have seen at least half this journey, seen about good 6 to 7 years in these companies, seen them mature from a startup where anything goes to becoming a more mature, serious organization. So that talent pool is what I'm betting on, and I feel that that's what every investor is currently betting on, where you
Mm.
have this incredible talent pool that understands what it takes to kind of build from 0 to 1, has seen that journey, has come with a level of maturity, and now when they're coming asking for capital, it should be available to them.
Where do you see the fiercest competition for deals? Is it at the seed stage, the pre-seed seed, Series A, Series B? Because you guys have also gone through a bit of an evolution in terms of the stages that you guys are focusing on, right?
Absolutely. So we started investing as a family office from 2010. At that point in time, it was being run by Satvir, and then Jay Sumer, who's our partner, other
Mm,
partner, joined in. And in about 2017, to continue investing from the family office. At that point, we have invested across seed to what would kind of be called a Series B today,
mm,
and everywhere in the middle. But with a large focus on pre-seed and seed investments. Because
mm,
at that point of time, there was no initial risk capital. There was a lot of global capital coming in. You had your Sequoias, Lightspeeds, Accels,
mm,
and other folks. You had some homegrown funds like Elevation, Bloom, who were coming in and going later. But there was very few people who were touching super early stage companies. It was in angel networks, angels, and then nobody else. So at that point, just the fact that you could deploy capital was itself a differentiator. And on top of that, if you had a decent network, you'd be able to find some great entrepreneurs. Today,
mm,
I feel that at seed and pre-seed and seed, there is a huge and it's very good, because without that ecosystem developing, you won't have companies to grow. There's a huge amount of folks competing at a seed and maybe even a Series A. So our last fund was a Series A fund. And the fund that we're now launching, that's fully deployed. Our fund
mm,
two is a Series B fund. And we took a very strong look at the market before we decided why. And there are three broad reasons. The first is your global funds have started retreating. So your soft banks, your Tigers,
mm,
and some of your private equity and hedge fund folks who thought it would be fun to play in venture have
mm.
all thankfully retreated. So that does leave a pretty large gap and vacuum at your Series B and Series C.
Okay.
Second piece is that in India, now that we've seen companies that have reached IPO and that have successfully IPO'd and done well even after, we've realized that the time frame it takes to build a successful IPO driven company in India is about 12 years. That same number is about 6 years for the US, about 7 to 8 for Europe or some other markets. But it takes about 12 years here. That is the nature of the market. I feel that it could slowly speed up, but
Yeah.
that's the number that we've seen so far. So, and one major challenge that we're very well aware of is that returning liquidity to your investors is extremely important.
Mm-hmm.
In our case, the Thakrals anchor each fund with a pretty significant contribution,
Mm-hmm.
on like north of 15% in most cases,
Mm-hmm.
which is much more than any most typical GPs invest. So we are and the investors in the team are also invested in the fund. So
Mm.
we're very aligned on why we need to do well because we need to return capital. And it's only when you keep a focus on returning capital that you can build, let's say, a 30-year financial institution.
Yeah.
To be able to do that, we realize that if you invest at a Series B stage right now,
Mm-hmm.
there's a retreat in global funds, which means that there's a gap. That gap means two things. Number one, you can take a lot more time for due diligence. You can spend time with the teams. You can go a lot deeper, and because there's so much more data to analyze. The Series B
Mm.
company is doing north of about $8 to $10 million of revenue, which gives you a lot of data to kind of analyze to understand how they're performing. You
Mm-hmm.
can spend time with the team, get very close, and the valuations are sensible because you are investing in a space where you are investing at a stage where there aren't too many people competing or fighting or throwing crazy valuations around. Valuations are being considered a little bit more sensibly. So though
So there
and
hasn't been any correction even from the startups that raised during the peak cycle in Series A and now going to Series B. Has there been any kind of recalibration?
there has been a lot of correction.
Okay.
Some folks have had to bite the bitter reality and do a down round.
Mm.
Um, but and a lot of folks have actually realized, and some of the smarter founders, and I know a few of them who we are looking at actively, have when that bubble was there, they
Mm.
did grab the cash,
Mm-hmm.
but they understood what they were doing. So they still built extremely frugally. They didn't take that cash and blow it out. They
Mm-hmm.
used that cash to actually get a much longer runway. Instead of running for about 18 to 24 months, they took that runway and turned it into like a 36-month runway, which
Right.
allowed them to grow their businesses to a point where today they're ready for a really mature Series B.
Okay. So what are your check sizes for Series B, and has there been any has that kind of bracket kind of moved at all through this time?
So our check sizes for Series A used to sit at between 1 to 2 million, one
Mm-hmm.
to about 1.5. We could stretch it to two. In this particular, for our new fund, we are increasing our check size to 3 to 5 million because it's a Series B round. Now that isn't enough to take the majority in a Series B round, which tends to be usually about a $10 million round.
Mm-hmm.
It does allow us to have a unique positioning in the market. So when you asked about competition, the
Yeah.
second thing that we do is we have a unique positioning. Uh, most Series B funds cannot collaborate together because both of them want to lead. If they both want to lead, they both want to own 12 to 15% of a company. There are very
Mm.
few founders out there who are looking to dilute 25 to 30% of their company
Yeah.
at a Series
Yeah.
B.
Yeah.
And it's not a great idea.
Yeah.
Typically, they want to dilute about 20. So
Yeah.
where we come in is we say, hey, you know what? We're happy to invest and take that remaining 5 to 8% in the round.
Which
And what
means you
we
guys don't lead the Series B typically,
so we
or
don't lead, but what we do is we can commit upfront. So if we really like a company and
Mhm.
as I mentioned, we do outbound a lot of outreach ourselves. If we
Mm.
like a company, we can give them a commitment with a valuation range. Obviously, the valuation will be set by the lead, but we can give them a range that we're comfortable with and give them a signed term sheet. So they
Mm.
can use that to then go and when they're talking to a lead, they can say, hey, we already have Riverwalk.
Right,
Uh,
right, right.
and in
Okay.
many cases, we actually collaborate because the amount of folks who can do Series B are fairly few. So we can actually share it amongst our network. We can have a conversation with some other Series B folks. And we have done that for portfolio companies in the past.
But how would you kind of define your like Riverwalk's kind of value add versus all the other kind of Series B funds that are out there in the market now? Because
Kristie, you hit upon a really good question. So across the last few months, I've been having a lot of conversations with friends at other funds, usually partners or principals.
Hmm.
And I think it's really important for a fund to justify why it exists.
Mhm.
Because otherwise, if you're just randomly taking capital and spraying and hoping that
Mhm.
we keep questioning startups on why they should exist. We keep saying, hey, what's your edge? What's your specialty? Why are you going to do this better?
Mm.
Which is a question we need to answer as funds as well. What is our edge? What is our specialty? And what is our right to exist?
Mhm.
And we've had this conversation across with Riverwalk, with our entire team a lot. And we've come down to a couple of precepts. The first one is that we bring a founder revenue. So we are a lot of our investors can't name them right now, but a lot of our investors are effectively the families that run large public companies in India.
Mm,
A lot of these companies have also gone global. And typically when startups, especially folks who are working in SaaS, or catering, in anything to do with manufacturing,
mhm,
want to get new customers, they reach
mm,
out to these folks. And inevitably, it's a 6 to 8 month sales process. It's really painful. Just to get
mm.
the right connects into the company is painful. What
Yeah.
we do is we speed that up, where we push this, at least get this seen at the top.
Mhm,
And the promoters can take a very quick call and say, hey, you know what, we like this. We think this solution is relevant for our business. Let's take a
mm,
look and take this further. Or, hey, you know what, this has no relevancy for our business. It's a no. But either
mm,
way, we get a very quick response for our portfolio companies. The second piece is we leverage the Thakral network. So the Thakrals operate in over 30 countries. When any of our portfolios want to go and enter a new geography, we actually
mm,
get them to spend some time with the teams, and also share with the family members that run that particular geography, so they can understand a lot of the local nuances. Who are the
mhm,
right law firms or financial firms to partner with? How do you hire here? What is the
mm,
culture in this country? A lot of
mhm,
these soft aspects and nuances is what can kind of make or break your market expansion.
mm.
So those are
My
the two aspects that we focus on.
Yeah, my guess also is because you guys have a pretty like the family itself has pretty strong B2B networks. It also helps you guys be able to audit and vet the founder team as well, right? In a lot of ways, whether this
In fact,
is a
that
legit founder
it,
team that's actually
yeah.
operating well.
In fact, that comes down more to the team itself. So Satvir has spent his life building his family business. Jay has actually started in a family business, then
Mm,
moved to E&Y, where he spent almost 5 years doing large M&A transactions.
mm,
So he spent a lot of time on deep financial services. And he understands the DNA of companies when they're trying to acquire other businesses,
mm,
apart from IPO, tends to be a lot of your exits for companies as well. So that guidance is available to founders. Our team consists of Keshav, who spent about almost 4 years, 4.5 years with Bertelsmann,
mhm,
leading Series B investments. So he's been writing checks of $10 to $15 million. And I obviously come with my operator experience, which we will discuss a bit later.
mm,
And our associates, Abhishek and Ali, are extremely strong. They both bring different sides of business. One comes from one of the IITs, which gives him access to the IIT alumni network, and also
mm.
the thought process of an engineer.
Yeah.
And the other comes from a private equity and corporate M&A background, which gives
Mm.
him a lot of financial understanding, as well as what companies look at when they're trying to buy a business.
Would you still invest in a founder that is kind of a first time founder, or do you think? Well, I mean, my guess is in India, there's probably enough people to go around that has said like they've done two, three businesses already. But this whole mentality, right? In like, especially in the US and Silicon Valley and even in Southeast Asia for a while, everybody, well, there was no choice. I mean, you had this generation of people who either came off MBA and all that. Do you think that still works, or are you still kind of leaning towards maybe people who came out of a family run business or have done, a business two, three times, that sort of experience.
So the good part about investing at this stage at Series B is,
Mm,
my answer is the numbers first.
okay. Yeah.
If you could have been nobody and come from nothing, but if you
Hmm.
build up a business that's solid enough to hold its own and come to our table as a Series B investment, we are going to give you absolutely the absolute same fair consideration,
Mm,
because it's now the numbers that you've built up. If you've built a business that's doing 6, 7, 8, $10 million, you've really achieved something. It
yeah.
doesn't matter whether you didn't have experience before. But at the end of the day, investments are limited, and we are very consensus. We are very non-consensus, but we are very high conviction fund. So we are
Mm,
looking to do 12 to 14 investments, which means that
mm,
we don't have the room to spray and pray, and a few can, like, a lot can die and a few might win. We're
yeah.
looking to really make sure that we're backing strong companies. So we do look at every reason. What kind of led to the success of this company? Why has it reached here? And more importantly, are we investing at an inflection point? Can this capital suddenly make this company scale even bigger, even faster? Because
Mm,
maybe I can just break it down. At seed and Series A, you're underwriting the ability of a founder to execute whatever crazy idea they put on paper. Can they make this reality? At Series B, you're looking at it and you're like, hey, you know what? They've been able to turn that piece of paper into reality.
mm-hmm,
They built by any standards a decently large business, like something that's doing $10 million. Now
mm-hmm,
the question is, what we're trying to underwrite as investors is,
mm,
can this founder expand this business? They've been able to prove it. They've been able to get from 0 to 1. Now can they go from like 1 to 10? Can they
mm-hmm,
can they go to different geographies, or can they increase the set of products that they're selling? Because
mm-hmm.
that's the only way you can increase your revenue. You can either go after new markets, or you can expand your markets horizontally in the same geography you are.
Mm. In the context of India, I mean, especially with regards to exits and where IPO markets are kind of heading in India right now, I mean, when you look at your portfolio and based on, the number of conversations you've had with, several founders, how should India founders kind of think about whether to take a M&A exit or whether to do an IPO, given the trajectory of where, India markets are kind of heading these days?
Kristie, great question. And I think that founders, we've had this conversation. I mean, I've had this conversation on a personal note with founders. We have it on with our portfolio. We tend not to try and have the conversation too often, because you want to keep your eye on the immediate goal, not what's going to
Mm,
happen, like
mm,
years down the line. But in terms of just a strategic way to think about it, the the questions I would think of as a founder are, number one, and this is very important, because if the founder's heart is not in it, and they can't find a good replacement, then you need to take a call. Am I willing to continue running this company? Am I willing to continue building this company?
mm,
And for some founders, that answer is absolutely yes. It's their baby. They don't want to let go. They feel that they have another decade or more in them to build this company out. In which
mm,
case, you've already answered your first question. I don't want to sell my company. I want to run it. In which case, the IPO tends to be your ideal option.
mhm,
The second question is this going to benefit my company? Because a lot of times there are companies that are acquired. I mean, I can share one example. If you see, there's a company called Haptic that was
mm,
acquired by Reliance, and it was acquired with a very specific request that the founder stay on and continue building the company. So now you've cashed out as a founder. You've
yeah.
got some liquidity. You've got some reward. You've also been able to give that same reward to your team, because at this point in time you're getting a large acquisition, so your
Mhm,
ESOPs for your team convert. You made sure that the people who've given you blood, sweat, tears have
mm,
also been rewarded, which is
mm.
really important. And
But
you're being
okay, sorry. Continue.
and you're being able to build, with the credibility of one of the largest businesses in the country behind you.
Yeah.
So now when you're going to sell, hell, at that point they started going abroad, because now you're not the tiny Indian AI startup. Now you're
Mm.
uh, Haptic, owned by Reliance,
Yeah.
which is a very different conversation when you're going to new markets to sell.
Yeah. Well, then the second part to that question will be if you're talking about a Reliance that is being an acquirer for, say, Indian startups, right? How are they incentivizing? Like, how are the due terms kind of, has there been an evolution in terms of the kind of M&A due terms that they've had with some of these acquirers? Because sometimes they may not necessarily offer something that incentivizes the founder as well as the ESOP, the founding team to be able to continue, right? And then in some cases, they may just take their money and then everyone just kind of disappears, and which is not exactly the best outcome for the acquirer. And I mean, it could work the other way as well, right? But like, how have those kind of conversations and negotiations kind of evolved? Have you seen any change recently or
Yes,
no?
so Kristie, you're
Why
absolutely
would
spot on.
anybody, yeah, why would anybody want to be acquired by a local guy if he's not going to offer anything that's going to be, tempting to begin with?
So I think a little bit of a difference between kind of a Southeast Asia and in India to start with.
Mm,
There are a lot of the breadth of large businesses are significantly more. Your Indonesia, your Philippines, your Thailand is very, very concentrated with like a few large businesses owning everything.
Mm,
Versus in India, while there are, of course, high concentrations, they are also uh, I wouldn't know if I wouldn't be able to accurately say hundreds, but happily
mm,
say there are more than 100 companies that are $1 billion plus that can do a pretty large acquisition.
mm,
So that have the appetite to do an acquisition of 25 or 50 million, or even stretching to $100 million acquisition. The
mm,
second thing it's important to remember is that for global companies, India itself is a concentration. So, for example, Hindustan Unilever is a partnership between a local company and global Unilever that acquired a D2C brand for close to $500 million,
wow,
which if you just look back even a decade ago, would just never have happened
crazy. Yeah.
ever. So you're seeing that kind of appetite for acquisition coming up. You're
Mm-hmm,
the In the evolution of deal terms, I think a lot of local businesses have realized that startups are founder driven and startups are team driven.
mm,
When you're buying it, you're not really buying it purely for the IP.
mm-hmm,
You're buying it to bring these teams into your fold, to bring innovation that you didn't have. So a lot
mm-hmm,
of the deal terms have definitely evolved to have longer lock-in clauses where the earnouts are really attractive, and
mm-hmm,
those earnouts scale if you stay. So if you leave the day the acquisition happens, you don't leave. You make some money, but not much.
yeah.
However, if you stay on with that company for a 3, 4, 5 year period, that payout could significantly escalate.
So there's a vesting schedule that kind of extends over the
So it's
course
not
of.
just a vesting schedule. A standard vesting typically is always just, hey, you leave today, you get 25, you leave tomorrow, you get 50. But
Mm.
what they're doing is they're tying it to revenue from that business unit. So if you double
Uh,
your revenue, that 50 could now become 100. So your payout year on year can go up.
interesting,
Yeah.
interesting.
They're
Okay.
tying it to revenue, they're tying it to business targets.
Yeah.
And in many cases, they're actually looping in some of these folks that they've actually hired to run other
Mhm.
parts of their business, because you've got a great founder who built
Oh,
innovation and built
cool.
an innovative company. So can we kind of build that innovation somewhere else in our company?
Oh, that's nice. I mean, yeah, I guess sometimes, with the mindset of like being acquired by a very traditional kind of corporate, they may not necessarily like the idea of like a hit company with a very traditional mindset trying to run a venture that has just been acquired. And then there's a kind of clash of culture and management style, I guess. Maybe, I don't know.
It's not okay. It's not as pretty as it's not sunshine and moonbeams.
Yeah.
There are stories I've heard of where the founders have just got irritated, the teams have gotten irritated, they've quit. But the thing that I see as a positive is that folks are learning.
Mm-hmm.
If you've done an acquisition, it's gone badly.
Mm-hmm.
In many countries, in many organizations, you'd put your hands up and say, "I'm never doing one again."
Yeah.
A lot of Indian companies are, if they've done an acquisition badly, are spending time analyzing it and said, "Hey, what did we do wrong in that acquisition, and what can we do better in the next one?"
Mm. Okay. Interesting. The other question I had also, you earlier mentioned about time the time it takes for in India for a company to be able to hit exit, whether either by M&A or IPO, is about 12 years, right? I mean that most likely is a historical data, taking in the amount of capital that has entered the market over the last like decade plus. Do you kind of see that compressing at all? If so, how much, and how much do you expect it to compress? Because there is still a lot of capital entering the market, yet at the same time, there's been also a bit of correction broadly in global markets.
I think the correction in global markets, there's definitely a lot of volatility in the world,
Mm,
and people are scared. I mean, I have this conversation with LPs or potential LPs all the time. That they're like, "Hey, yeah, we're really excited, but we're also really scared. We don't know what's going to happen,"
mm,
and that uncertainty freaks people out. But when I look at that timeline shrinking, I think it will for two major reasons. By how much, I can't predict. Can it go down to 10? Can it go down to 8? Can it go down to like a more globalized 7 or 8 years? That's possible because of two reasons. The first is more experienced founders, where this is effectively first gen. What has passed by until about 2024.
Mm,
from about 2005 to about 2024 was your
mm,
first gen, your first, let's say, your first run, your first innings.
mm,
In
mm,
2005 to 2014, 15, the first few companies were built. Nothing became, there were really no massive companies built from that point. Some of the companies that were founded in your early 2008, 2010 have today matured into large companies that have IPO'd. So it's taken more than a 12-year period. Actually, it's taken closer to a 14, 15-year period. Some of the
mhm,
companies that then started a little bit later in your 2011, 12 have also somehow managed to IPO around the same time.
mm,
So that's where you get that 12-ish number from. Now you've got a whole bunch of folks who made money from ESOPs, who've actually seen the upside, who've seen the success, and who are now stepping out and becoming the next generation of founders.
mm,
So a lot of the mistakes that these early set of founders made, because they didn't have any playbook, they didn't have any guidelines. A lot of them tried to follow US guidelines and very quickly realized that almost nothing that works there can work here.
yeah,
You needed to really build your own playbook.
yeah,
So that playbook didn't exist. Today, I feel that that playbook is a lot stronger for India. You really know what it takes to quickly test in a market, to test things out.
mhm,
And most importantly, your large customers are so much more receptive. I mentor a lot of young companies, and I've spoken to folks who are run by like people who are under 30, who've been around for 7 months, and they're like, yeah, we are currently doing our demo. We're doing our demo with XYZ large company in India. And yeah, we're coordinating directly with the C level. And I'm like, this just wouldn't have happened a decade ago. You wouldn't,
yeah,
like, no large Indian CEO would have picked up the phone and answered a 25 crore pitching a tiny company. They would have just not. And today they not only answer, they are actually accepting the fact that, hey, yeah, let's do a pilot, let's test this out, let's see if this can
wow,
help our company out. So that's speeding the time of getting
yeah,
understanding whether you can get to product market fit, getting mentorship, getting a lot of times these large companies are like, hey, yeah, this problem, if you solve it in this particular manner, we'll give you a contract.
yeah,
Uh, Solve it for us. So that has actually sped up. That's the biggest change in what's going to speed things up. And the second, I'm going to be forced to say AI. Yes, it can make it faster,
yeah,
a little more efficient. But the biggest chunk is the first. It's the
yeah.
mindset shift as well as this set of experienced founders.
Yeah. I mean, what you mentioned about the first bit, big corporates kind of taking up pilots and contracts. I mean, that's come up so much in, at least in Southeast Asia. I mean, I hear that it is changing, but it's still really slow. I mean, a few months ago, I spoke to one of the deep tech VCs here, and he was saying that interestingly, what has happened over the last maybe like 5 years or so is that it's actually the governments that are responding more quickly than the corporates, which is kind of not what that was not part of their original thesis. They thought that maybe the corporates will be the ones stepping up, but actually it's the other way around. The government is the one that's kind of leading the way. And they end up becoming the ones that are picking up pilots. But still, it's taken like several years. I don't know. It sounds maybe in India things are probably a lot faster than even in Southeast Asia. But maybe if you can backtrack into your career journey. I mean, you said you spent about 6, 7 years in Singapore, right? What led you to Singapore to begin with, and then what led you out of Singapore?
So my career hasn't followed a very traditional path outside my job from graduation. So
Mm,
I did my degree in economics, post which I joined a technology company. So there's very little correlation to either of the two. And the technology company happened because I was a part of this global network called ISEC, where we had a bunch of student volunteers. We used to organize events. We used to actually foster community and peace through cultural exchange. So we'd actually work
mm,
with corporates all around the world, and we let's say, how do you make I'm not going to name any country that hates each other. How do you make sure that people just like each other? Just if there's exchange, if people go and live in that other country, work there, spend some time, make friends, that's one of the best ways to kind of have cultural exchange. So that was the thesis behind ISEC, and it's still a pretty large global organization. I think 180 countries or something. So
okay.
was volunteering there, and that's what got me into a technology company called DirectEye. And DirectEye was an incredible experience. It was built by two founders who dropped out of college, took a $500 loan from their dad, repaid that loan in 3 months with their profits, and
Wow.
kind of built a business that in about 11 years they exited $4 billion. Uh,
Wow.
yeah, so it's one of the best hidden stories of entrepreneurship, I think, that exist.
Cool.
Yeah. So working there was an incredible start, because I was just looking at this company that was built by created out of nothing by these two brothers.
Uh-huh.
And they really wanted to emulate some part of kind of your US Silicon Valley style. So
This was in India, right?
this was in India. So we had a massive office. This is in the end of 2011, beginning 2012. We had an office in India that suddenly said, hey, no shirts, no pants. Here's a beanbag if you
No
want,
shirts, no
double
pants.
screens. Yeah, you don't need to, like, because Indian companies, like a lot of Singaporean ones, are very obsessed with, oh, you must be very well dressed. You should wear a full shirt, tied up your button, put a tie on, wear like,
Wear a Patagonia vest, in
yeah,
Singapore.
and they, and in these tropical countries, they want to dress us to dress like you're like living in Britain.
Yeah.
And this company just said absolutely no. Just wear a t-shirt, wear shorts. Like don't like wear shorts if you want. Just come in, really get your work done. We're not checking. You don't have to show up at 9 a.m. You have to
Mm-hmm.
clock. You have to finish your full work day. But if you choose to make that 11 to 8, that's your problem.
Mm,
And if you want to come in at 8 and leave at like 5, that's also your problem.
mm,
The
mm,
only common timings was 12 to 5.
mm,
So apart from that, you can adjust your beginning and ending as you will,
mm.
which was a level of flexibility that nobody had heard of. They'd given us like a gym, a bowling alley, a lot more. Yeah, we had a bowling alley. So I was like,
Oh, fun.
you look forward to it. You look forward to coming to office. You look forward to working. You look forward to free or virtually free meals.
Yeah.
Great free meals. And then when you're done, you can just go to the gym, finish a workout, and go home. Which just made a great life.
Wait. How did this lead you to Singapore?
Getting there. So because I was in technology, some friends
Ah,
of mine,
yes.
and this was pure luck. This was absolute pure dumb luck. I'd studied in a boarding school, like a residential school where you stay on campus. And one of my friends, and over there, because you're all together, you're all wearing school uniforms, you don't know the relative wealth of of other people. And one of
Mm.
my friends turned out to be from an extremely wealthy family, and they wanted to start investing in startups. So I joined them to set up
How
their
old were you?
family office, 22, 23.
And
Uh,
he was given money to invest in startups?
yeah.
Damn.
No, the family was very forward thinking. They realized that
Oh,
startups would be a
wow.
great avenue for investment.
Cool.
So they brought me on and we started investing. So for about 5 years, I was investing on their behalf. And that's when I realized, okay, this is fun. This is really fun. And I've learned a lot.
Yeah.
But they didn't want to scale their family office up to anything more professional. And I definitely wanted to do something larger.
Mm.
And I spoke to a lot of different advisors and mentors, and they all said the best way to become a great investor is to go and build something. I was like, okay, I don't know what to build. So then they're like, okay, go help somebody else build something.
Mm.
So that's when I reached out to the founders of Zilingo, which was a company that was just becoming the talk of the town across Southeast Asia.
Oh, interesting. Okay.
Interviewed, and the next thing I know, I'm on a flight moving to Bangkok. So I spent a year
Oh,
there, and
wow.
then they moved all the lead, and I got a promotion, and they moved all leadership to Singapore. So
Okay.
that's how I ended up shifting at the end of 2017 to Singapore.
Wait, it was founded in, oh, yeah, it was founded in 2016 or
Yeah,
2017, right? So you're
it was
part of the
founded
founding team.
mid 2015.
Oh, okay. So you were
Mid to
actually
end
part
of
of the
2015.
founding team,
Kind
kind
of,
of
yes.
like
Yeah,
early team.
yeah. I did become part of the leadership team later, so that's
Yeah.
separate. Yeah.
Oh, okay. So that must have been a very interesting roller coaster journey, because I'm sure the lingo of day one was very different
Very different.
to the final story, the final chapter.
In this particular aspect, I mean, my simple answer, I'm not going to go too deep into this. That's an entire separate child
I got
podcast.
you on camera now.
Yeah. But it's a result of two things.
Hmm.
Overfunding,
Hmm.
genuine overfunding. Companies thrive and do really well with just about the right amount of capital.
Mm.
And when there's too much capital, you don't know what to do with it, number one. And
Yeah.
number two, the more scary part is that you need to grow into the value, you need to grow into the crazy valuation that you've been given. You actually need to achieve business that says, hey, I'm $1 billion company now.
Mhm.
So when we raised our last massive round, which is the company raised with me because I was part of the raising team as well, or
Yeah.
over $330 million across the company's life. And I mean, when we raised our last round, which was $226 million in one single check,
Yeah.
I thought that was just too much money. And when we got it, we didn't have the plan in place on how we were going to spend it, on what we were going to use it for, and how we were going to use that money to kind of get to
How's
the
that
growth.
possible? Like, wouldn't when you raise, you should know roughly like what you want to use the funds for, right?
You'd really think that was those times were a little
Oh, yeah,
exuberant.
okay, fine. I know, but I mean, I guess maybe I'm trying to get into your head at the point of time. But okay, to be fair, it was also your first kind of proper
Yeah,
operational role, right?
yeah,
So
that was what I learned.
at what point did it kind of in your head kind of did something kind of click and be like, okay, something is a little bit off here? Because the to be fair, at that point of time, everybody, it was the first time for everybody. Like there were a lot of first time founders, there were a lot of first time investors too, and everyone was just kind of caught up with the hype of everything. So you a lot of like even what we're talking about now is everything is on hindsight, right? So but for you, when you were in the on the inside, like at what point did something kind of feel a little bit off?
It started pretty early for me. So across 2018, because I was investing for a family office, because every time I
Mm,
wanted to do an investment, I had to justify exactly how in some time this company is going to make money. Even the family is very understanding. They're like, yes, startups will burn. But they're like, but at the end of the day, Avik, a startup has to become a business. That's
mm,
the goal. That's the point. So
mm,
at what point, and more importantly, how is this company going to go from losing money to making money?
mm,
And that's been ingrained into my head as the right way to invest. And now
mhm,
today, after 13 years of investing, I can say I'm I'm going to stick to it. That's the right way to invest. But at that point in time, in 2018, I was pushed to burn money in methods I didn't like.
mhm,
And it was all in the name of growth. Let's grow the top line. Let's grow the
mhm,
numbers. Let's
mhm,
grow. And it just irritated me. But at the end of the day, I was like, hey, I work for the founders.
mhm,
I'm not the founder. And if the founders are the people who built this company, at that point, if I didn't want to do it, I should resign and leave. Or
mhm,
I should listen to them and
mhm,
do because I tried pushing back, didn't work with a lot of
mhm,
logic. So I said, okay, they built the company, let me do what I've been asked to do. And I kept doing that, and the entire company kept doing that. And the reward for that burn growth in 2018 was a massive check in the beginning. In January 2019, we were given $226 million.
mhm,
So I'm looking around like, maybe this is what you need to do to raise that kind of money. Like, maybe this is the right answer. Maybe this is the way. Because clearly that's what global investors are reinforcing. They're like, hey,
yeah,
all the biggest investors in the world are saying, hey, you burn, but we're going to give you more,
mhm,
uh, which wasn't the case. But so
yeah.
then we kept burning. And then the question started coming from the same global investors who had loved the burn, saying, by the way, how are you going to make money? And we're like, what? We weren't told we had to make money. We were told we had to grow.
Mm.
And then that resulted in the company having its own problems. And as I left the
I
company,
mean, to be fair, the investors were also part of the whole hubris that, we kind of witnessed, right? I sometimes think that it's not just the founders as much as, of course, the founders had a huge role to play because ultimately their name is on this company. They were the founding team and everything, but the investors had a part to play in all of this as well. I don't think it's fair to just point the finger at just one party and say like, oh, it was all your fault. Um,
I fully agree. I fully agree. While I don't think it's enough to say that, hey, it's not the founder's fault. It definitely, and I can confidently say, being in the company, that there was a decent amount of lapses on their part. The investors have a fiduciary duty. At the end of the day, they're supposed to represent whichever organization that's given them money, whether they're a large sovereign, whether they're
mm,
a pension fund, whether they're a VC fund which is raised from a whole bunch of LPs. They are responsible to their investors.
mm,
And I saw a lot of that responsibility kind of just waived,
mm,
where people weren't keeping their eye on the ball. Everyone looked at the shiny growth, the shiny new things, and People
Mm-hmm.
weren't looking at, hey, is this building a real fundamental solid business? That question was not being asked enough.
Mm. So, okay, so at what point did you leave then?
I left at the end of 2020.
Okay. So that was when things were kind of like 2020.
That was, I mean,
Did you move
basically,
out?
I didn't enjoy
I think it was
2019.
before everything kind of came out, right? I think.
I wanted to leave a little earlier, but I'll just be, and I could say this selfishly and honestly enough. When COVID started, you don't leave a business when there's that much global, you don't leave a job when there's that much uncertainty in the world, especially not when you're on a employment pass.
Yeah. And so at the point, so that was what made you leave Singapore or?
No, so I left Zilingo. After that, I ended up meeting some fabulous folks from who were building a company inside Entrepreneur First, like in one of those cohorts,
Oh,
like an Antler.
okay.
And they both had a lot of technical ability, but they didn't have a lot of business side knowledge. So
Mm-hmm.
that's why I came. I joined first as a founding team member, and then they later brought me in to lead, like as the CEO, to lead the company. We were building in the insurtech space. So that was a really fun run. We weren't we weren't able to turn it into what we wanted, but we managed to get at least make sure that the IP that we created became valuable. So there was a share swap with a company in the UK. So we turned it. We basically turned a company that we built out really well for a year into something. It wasn't the
Mm-hmm.
kind of exit I wanted. It wasn't the build out that I would have wanted for a company that I was building, but it was what it the situation was what it was. I mean, I can share something really funny that happened during
Mm.
when we were building it. So we were building software for dashboard cameras in cars that would
Okay.
then connect to your insurance actuarial tables
Mm.
and and be able to understand the risk of consumers and fleets, especially fleets, a lot better, so that
Mm.
we could adjust the pricing. This
Right.
that was in the short term. In the medium term, what our goal was once we have this software and these devices in enough cars, we'd be able to understand what really causes road accidents, which is
Right.
data that is then valuable to governments, where
Right.
I can confidently tell you that, if you change the degree of this turn by 3 degrees, you could reduce fatalities. You could
But
save
you guys
lives.
are the software layer, you're not the hardware,
So
right?
so in the beginning, the goal was to be the software layer, but in the
Mm.
beginning, there was no hardware available commercially, uh, easily enough
Mm.
that could take our software. So in the
Mm.
beginning, we were just sourcing products that were basically from an OEM in China, and
Mm-hmm.
we were plugging our software into that, rewriting the codes, putting our software in, and giving it out. Now, what happened was when we started the business, that those devices used to cost us $60. And I had spent a lot of time building that business plan. I'd spoken to virtually everybody I knew in electronics, and people had confidently told me, electronics doesn't have a price fluctuation of more than 6-7%. You're
Okay.
fine. I mean, year on year it'll go up, but every year when you budget, you're absolutely fine. There's not going to be more than that change. So I said, okay, fair enough. As a startup, let me buffer 15%.
Okay.
Now, 2022, when we were building 2021, when we were building this, was the when the chipset crisis kicked in. So there was a
Oh,
huge crunch. So my
okay.
device cost went from 60 to 70 to 80 to 90 to, at one point it was $120.
Oh shit.
And I'm looking at this, I'm like, this business was viable at 60. This business was barely viable at 70. This business is not really viable at 80. And at 120, this business is screwed. So,
So that's
and
how you guys ended up selling.
yeah, because we were like, we don't know when predictably this crisis is going to be solved. Uh,
Okay.
so we ended up letting the company, I mean, giving the company over to somebody else. Post that, I spent a little over 2 years with a wonderful company called Janio, which
Mm-hmm.
is Singaporean logistics. So it's a fourth party logistics player.
Mm.
We coordinated. We used to work with some of the largest like e-commerce players. We worked with Shopee. We worked with Lazada. I'm
Mm.
probably pretty sure the company still does with Nike, with Swarovski, with Disney. So that was really fun. I got to really understand the in depths of how e-commerce cross-border shipments work,
Mm-hmm.
as well as large freight. So
Mhm.
one of the initiatives that I helped pilot was we did our first charter flight. We chartered an entire plane
Mm,
for cargo, which was fun.
cool. That's really cool.
You don't get to
So
fly on it, unfortunately. That would be really cool. So, a charter plane, but no.
that would be even more fun if you get to sit on the flight that you chartered. So at what point then, I mean, what led you back to India then? Because you were away, well, and I guess, I mean, do you think that your perceptions of Southeast Asia, because I think for a while, especially in the earlier days, there was this idea of like India being kind of a few years a little bit ahead of Southeast Asia. There were a lot of, in terms of the maturity cycle, there were a lot of things that we could emulate from India. What were some of your assumptions before going to Singapore and then leaving Singapore? How did your perceptions kind of change?
So with Singapore and with when I moved, I ran 5 countries for Zilingo, and one of them was India.
Mm,
So I was basically acting as like country manager for a bunch of different regions. While running it out of Singapore, I was basically on a flight. So I was in Thailand or Indonesia or Bangladesh or India or even heading to the Middle East. And
mhm,
like while I had a colleague of mine who ran the China market, because of course language would be a barrier for me. I used to frequently go there with her as well. But my I loved it. I think as a country, Singapore had set up everything very right for entrepreneurship.
mhm,
Um, Rules and regulations are extremely clear, straightforward, very well thought through. It's set up. Enterprise Singapore does one of the best jobs I've ever seen. When I needed to go and find new clients in the Middle East and in Europe to buy from us,
mm,
the ESG team kind of opened their doors. Like in London, they were like, here's our Mayfair office, here's a boardroom. And by the way, we've
wow.
also called like 5 people to meet you. I was like, this is just incredible. So as an environment, I think Singapore in that sense has really set itself up well for companies. What I think breaks a little is when companies try to expand across. So the way building is in Indonesia versus it's Thailand versus a Philippines versus a Vietnam. They're all extremely different and difficult markets to build in,
Mm,
where capital efficiency matters a lot. Where I think a lot of companies have gone in and tried to burn to grow,
mhm,
and that's been the wrong answer. When you see solid companies that have come out, like a Zendit, for example,
mhm,
they've been very smart and very frugal on kind of how they've built out, how they've scaled. Even like an Aspire or a deep tech like a Bioformis, these companies have built really carefully. But then when you see some other ones that have just gone nuts on spending money, that's where
mhm,
you realize that a lot of things broke, where they didn't
mhm,
really think about fundamentals.
mm. Yeah.
So, so I think if you I've done a little bit of data research on this, and it might be fun for anyone who's listening to kind of do it yourself, is take a look at the amount of funding that went into a Southeast Asia versus in India, from I
Mhm,
think 2014 onward, and you'd be shocked by the sheer numbers in Southeast Asia where funds have just raised, you know, 300 million, 500 million, 700 million,
yeah.
whereas like Indian funds that have returned capital and have
Yeah.
done well. And like, in their first funds, they give return like 4x, 5x, as opposed to the Southeast Asian funds that have returned close to zero, are
Yeah.
still struggling to raise like, a 50 million fund.
Yeah.
Uh, so it really blew my mind. So one of the reasons why I left was I realized that venture was kind of the space I wanted to be in. Venture or work with some exciting startups. I didn't
Mhm,
see companies that I was excited enough to kind of be part of. You either
mhm,
have your big tech, like go work for Google, Amazon, or VC funds were bleeding. I could already sense that they were in a struggle mode. Versus in India, the all signs pointed to, hey, this is growth time.
yeah.
And even in the last, even the in the hell, the entire 7 years I'd spent there, after the first couple, every week I'd get like a headhunter offer saying, hey, would you join this startup? Would you join this fund? Would you join this startup? Would you join this fund? And like,
In Southeast Asia.
in from India.
Oh,
In
yeah,
Southeast
okay.
Asia, maybe one every like 6 months. But
Mm,
in India, they're like calling like every week people are calling. So it's like clearly there's something going on in this market that I'm missing.
yeah.
And if I want to invest here, I probably need to come back.
Yeah. And you've been back for the last like year or so, right?
I did. And Kristie, even before that, so in my span in Singapore, I made a lot of personal angel investments. In fact, my
Mm,
first was in a Singaporean company, which
mm.
actually gave me an exit, so I'm happy. But post that, every time I looked at companies, and my friends were sending me opportunities from India, and I was
Mhm,
looking at opportunities from Singapore or
mhm,
Indonesia or
mhm,
Thailand or Vietnam. I'm looking at, okay, both founders want to raise, let's say, $1 million. I'm
mhm.
looking at the quality of the entrepreneur way superior in India. I'm looking at what they're bringing to the table. The Southeast Asian guy is like, oh yeah, I worked for Google for 6 years, give me $1 million. The Indian guy is like, no, I slogged my ass off for 10 years and I built a company that's already doing 50K or 100K every month in revenue.
Yeah.
Please give me money. I'm like, obviously I want to give it to
Yeah.
the,
Yeah.
the guy who's bringing a lot of traction to the table.
Yeah.
Um, so it just also made me feel that like a lot of Southeast Asian entrepreneurs have gotten a little spoiled, where they're just like, yeah,
Oh
funding
no.
just funding just shows up. I'll just build with nothing. Um,
I mean, I do
and
wonder. Yeah, I don't know about now because I don't even know if there are numbers in terms of number of new startups getting created in during this season, right? Especially now that the funding cycle and everything has gone down. There's this huge question around the future of entrepreneurship in this region. Kind of compounded with all these different factors that we're seeing on a macro level. And there already the whole idea of like risk aversion, and all of that stuff, which is kind of sad because, I think there were a lot of hopes that, things could have moved in a different direction, but it suddenly feels like, no, we just went kind of one big round almost. Um,
Christy, it's really funny. It kind of ignores the godfathers of investing. Warren Buffett has always said it. Be fearful when others are greedy. Be greedy when
mhm,
others are fearful. You
mhm,
don't make money in markets where everyone's
yeah,
exuberant. You make money when you're willing to invest in a market that everyone's not looking at. So
yeah,
I think that, and we've spoken about this. There are a few
mhm,
wonderful funds who are really putting a lot of effort out there to 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 understand what's needed in Southeast Asia, to understand how much capital should be given, what kind of companies need to be built. And
mhm,
I've resonated with a lot of posts from a few folks like Jeremy, where they've
mhm,
always been very clear. The fund needs to be right sized to the market, be right sized to the opportunity.
yeah.
And I think that opportunity still exists in Southeast Asia.
So, like, okay, I mean, you mentioned, I mean, you kind of deliberated a little bit about your own experience, and, being a former operator and, having angel invested as well. So you kind of like have both hats on as every time you look at deals and having gone through this kind of journey, like how have your own kind of perceptions and views towards investing and even vetting for founders, has your approach changed or shifted at all over through the years? Are there specific things that you look out for when you look at, the deck when you meet a founder?
Yeah, majorly. I think the approach has only gotten more refined. I
Mhm.
wouldn't say much has changed. I think it's gotten more refined. So when I started, as like anybody else, I started looking at companies that, oh, what would make my life happier? What would make me happy? And then I ended up seeing, oh, there's this company that allows you to book restaurants, or get like personalized experience at restaurants. And as a naive young investor, I was like, yeah, this would work for everybody. So it really took me a lot of time, effort to understand that there are certain rules or playbooks to investing that have been created for a reason, for
Mm,
VC investing. And to
mm,
get venture capital like returns, these are some of the ones that you need to follow. So one of the first major ones is if you just make sure you're backing a great founder. Because whatever said and done, once you put that money in, that money is locked in. So you want to make sure, and that money could be locked in for like 10 years. You want to make sure that you back the very best person at that point of time that you could give that money to.
mhm,
The second thing is that even a great founder can't beat a bad market.
mm.
So a
Okay,
great
wait,
founder can
pause. Back to
a
founder.
great founder will typically find a better market. So what everyone calls pivot, but a
Yeah.
great founder cannot beat a bad market. So you also
But,
really
but
need to.
okay, going back to a great founder, like what in your definition is a great founder?
It's It's hard. I lean towards folks who have a few years under their belt. I'm not the biggest lover of someone who's just come out of college saying I want to build a company, and I'll kind of give a couple of reasons why. The first one is you're going to make your first mistakes on my dime. I would much rather you make your first mistakes on somebody else's dime.
Okay.
Blow somebody else's capital up, learn,
And
then come.
everyone thought like you, and then we'll have no founders. Someone has to put some risk capital out there, you know?
So I completely agree. So it's all about the kind of funds that you want to build. If you want to do a pre-seed seed, you definitely need to build a bit of a spray and pray. There is
No.
no way you can do a high conviction approach with like a 15 company portfolio at a early stage. It's going to die because
Mm-hmm.
you may just not have hit any of the 15 companies that are going to break out. You have to build a
Mm-hmm.
large portfolio. But it depends on the stage. So I'm obviously speaking from a slightly more mature stage
Mm-hmm.
aspect. If you're going pre-seed, then just bet on the craziest founder you can find.
Okay.
Um, but once again, I would like that founder to have a little bit of experience, because even if I'm investing in a company that where the founder's just shown me a little pitch deck and there's
Mm.
nothing else, I still more importantly, I need to know why that pitch deck can become reality. So the first thing is that they burnt their hands with other people's capital. The second
Mm-hmm.
thing, and I saw this with some spectacular founders actually out of Singapore. So I'm still part of the Thai organization in Singapore. So we
Mm.
we we evaluate and angel invest or invest as a group into Singapore startups.
Mm.
So we had evaluated this company a few years ago. Two founders, both of them had spent almost 8 or 9 years in the semiconductor industry,
Cool.
working for large companies in Singapore. And then the two of them came together and they said, hey, you know what? We've seen a particular problem in analyzing like semiconductors that are broken, and it's actually done by hand. And we can come up with a computer vision solution that would solve this. And they just stepped out and they came and presented this idea at TIE, saying that, hey, we've already got some of our old employers are already ready to do a pilot test with us. So are
Mm-hmm.
some other friends of ours in other companies.
Cool.
And we're like, hey, you know what? We funded them, and the two ladies are just doing fabulously today.
Yeah, ladies.
Two
Wow.
ladies building in the semiconductor space in computer vision.
Pretty
Uh,
badass. Okay.
yeah, Six Sense is the name of the company. So we're like, hey, this makes sense. And the reason why they could do this is because they had the credibility that their previous employers were very happy to pilot, as well
Mm.
as friends who knew them, like people who may have worked in the same company and then moved to another company, who said, hey,
Yeah.
yeah, of course we know you. We'd be happy to
Yeah.
run a pilot test.
Yeah.
So once you've worked for a little while, your network is so much stronger. That
Yeah.
same pilot that a 23-year-old founder would have to make 100 calls and have the energy to grind and hustle, the
Yeah.
30-year-old is just going to pick up the phone and say, hey, let's do pilot. Yeah, okay.
Yeah. Yeah. Yeah.
Which is just so much easier.
Yeah.
I think, and probably the third is just a little bit of maturity.
Mhm.
Because once you're scaling a company over time, one of the biggest things that can kill you is your internal problems. Are you able to find the right talent, attract them, hire
Mm.
them, retain them, and make them better? And
Mhm.
of course, a younger founder is going to find that a lot harder to do than someone
Yeah.
who's actually managed a team before
Yeah.
and been experienced. So that does bias me a little bit towards experience. That
Mhm.
being said, I have met some amazing folks who have taken a bet on when they're young.
Yeah.
Yeah.
How do you vet for things like, I mean, self-awareness, maturity, character development? Like, I feel like these things tend to be quite intangible, and and you've seen it for yourself, right? Like, I think sometimes well, at least I choose to believe every founder starts a company with the right intentions. Everybody builds with the right intentions, right? The right idea and vision in mind. But sometimes when you fast forward and a lot of dollars later, that gets a little muddled. How do you, as a founder, kind of vet for that? Have you made mistakes before?
I have made mistakes, absolutely, but very, very rarely. I can say this confidently. So, out of the family office investments that I mean, I've led the family office before, and then I've been part of another VC fund, and then joined Riverwalk. So,
Mhm.
led, I mean, been part of or led over 30, I think 32 investments in total, followed by an eight of my own personal, so like 40 investments under the belt. I've integrity has been an issue in two, and that was early on in the career, because I realized that anytime you get pressured into investing faster,
Mm,
um, oh, the founder say, I have a timeline, you should commit in a week, otherwise you're out,
mm,
is generally a very big red flag for me. I succumbed to those in those two instances, and those two turned out to be integrity issues. Uh,
oh.
Great founders are timing their capital raise a lot better. They understand that raise takes time. They're not trying to go out to raise when they have 2 months of runway in the bank.
Mm,
They're going out to raise when they have 7 or 8 months of runway in the bank, or depending on the stage, sometimes more.
mm,
They're going in with a very tactical awareness of this is how long it's going to take, this is what it's going to take. They go in with ready DD, data rooms for any due diligence. They've already put in FAQs, they've already made it really crisp, and they're not afraid to let you talk to their team members one on one.
mm,
Whenever I've seen a founder who says, no, I need to be in the room, or you need to send the questions to me before, and then I'm going to be in the room, and my business head or this head or that head's going to answer, that's an insecure founder.
mm,
When founders have just been like, yeah, sure, this is the number of my team member, these are the few slots that you can call, go ahead. And then they let us have a one-on-one conversation with their team members. That generally gives a lot more comfort. I like to take my time doing diligence. I like to take my time spending time with the founders. And one of the most important, and it's unfortunate, but it is the most important, is reference checks. If
yeah,
you cannot give me good reference checks from your customers, from your vendors, maybe you're just great with your customers, but you're terrible with your suppliers.
yeah,
Eventually, they'll just give you the worst terms or stop supplying to you, which could kill your business.
yeah.
So I need to see all of that. I need to see that you have, like, you can manage your relationships on the buy side, on the sell side.
Mm,
If you have previous investors, how are they feeling? If you've had teammates, if you have a very high attrition rate, why is that the case? Why
mm,
are people just leaving your organization all the time? So
mhm,
these are kind of i- all of this, barring the actual analysis of the financials, are the
mhm,
softer aspects of understanding an investment. And I
mm.
think that this is where investing becomes an art, and this is what kind of makes or breaks a good investment.
How long does your DD process usually take, and how deep do you go into doing the DD? Because it will require you to actually make field trips and then call customers and actually
As
interview
many
them.
as it takes, as much and as many as it
Yeah.
takes to get comfort.
Hmm. Interesting. Are there any other kind of like, say, investment regrets that you've had, costly lessons that maybe you can share with the audience?
I can share one which wasn't an investment. It was pure greed.
Okay.
During COVID, everyone and their uncle was trying to trade like PPE, personal
Okay.
protective equipment. Like everyone was like, oh, I can get you masks, I can get you this. So
Uh-huh.
3M masks were kind of the ask. So I did get caught up in that exuberance, and a few friends of mine and I set up a company to kind of trade. And we made a little bit of money in the beginning, which led us to get, oh yeah, we're so confident. And then I committed, me and a couple of friends wanted to run a large deal, where we all put a significant amount of our personal capital
Mm.
in as kind of the down payment. And then that
Okay.
deal fell through, and I'm still fighting to get that money back. It's
What?
been almost 4 years.
Who
Uh,
did you pay? A
uh,
distributor.
we paid a vendor who screwed us over,
Oh shit.
and that money is absolutely stuck. So
Okay.
I realized, oh my God, doing anything when it's so much easier and better to just skip rather than do anything when you're too exuberant and too time pressured.
So the lesson is don't be greedy.
Don't be greedy. Don't be greedy. It leads to so many people have this thought process. I mean, I was
Yeah.
mentoring a company yesterday,
Mm,
and I generally keep a couple of hours on the weekends to kind of do this with founders,
mm,
and who are not portfolio. So obviously, I'm just
mm,
doing this kind of for other people. And this founder was like, Avik, I'm running this business. We do about 250K annually, and we're
mm,
growing. Like last year was like 100K. To this year's 250. Should I
mm,
take investment? Shouldn't I take investment? I was like,
mm.
what will? And they're profitable. Like they have few employees, built out a software. They're profitable. I'm like, what will change in your life if you take this money?
Mm-hmm.
and why are you doing it? And we had like a long existential conversation on what they wanted, the founders wanted out of this, out of
Mm-hmm.
life.
Mm.
And we just came to the consensus of don't raise funding right now. Just build this profitably, build this scalably, and maybe in a year, maybe in 2 years, if you feel like, hey, now I want to kind of blow this out or build a new product, I mean, you can raise then. But for now, just don't raise out of everyone else is raising, so I should raise money.
Yeah. Yeah. Interesting. Okay, maybe one last question before we kind of wrap things up. I actually wanted to bring it up in the very beginning, but I got to leave it to the end, which is this whole, I guess, kind of conversation around the H1-B visa in India. I think this is probably going to be a conversation topic for a little while more because I think it's going to kick in, I think, beginning of next year officially, if I'm not wrong. But already, I think it seems to be having an impact on, especially in India markets. I was reading this stat just now before we started. Actually, I think something like 70% of all the H1B visas that were issued in the last decade went to Indians, which is a lot. I guess it's not really a surprise considering that India is like $1 billion people market, but
Yeah.
it's still pretty staggering, right? Like it's a huge majority. I mean, what are some of your colleagues, your peers, what are they talking about these days? And um, I'm also wondering, right, like especially if you look at some of the VCs like the Peak 15s and all these guys who are kind of plying this US India talent channel, what's going to happen to them? Because a lot of those guys, the people that they're hiring and the startups that they're investing in are probably banking on that India connection and talent flow going to the US. So what's happening there?
I think uh, it's a net neutral for India. I am going to give, so I'm going to kind of
Neutral.
weigh, I'm going to kind of weigh in on the on both sides, on the positive, on what people are talking about on the positive and the negative. On
Mm-hmm.
the positive, there's so many people who are like, yeah, all this talent is going to come to India, and now we're suddenly going to have like all these jobs, all these engineers, and like my answer to that is they don't want the jobs that are available. For example, I mean, I can share. There's a very senior friend of mine, not mentioning a name, who specializes in UI and UX, has worked with some of the largest global companies, 15 years of experience, studied in India from the National Institute of Design, and then moved to Singapore, and been there for about a decade. And that friend was working with some of the largest companies in the world, where
Mm-hmm.
American talent companies, American or like technology companies spend a large amount on UI and UX. It's a very important piece for them. How the product looks, how it feels, what's the friction points. It's a huge investment. And when that person was chatting with folks in India, and of course there were headhunters who were desperate. They were like, "Oh my God, your experience is so amazing. Please come and join us at
Mm-hmm.
at a 60% salary cut." The
What?
person's like,
Oh no.
no,
Yeah.
you pay me what I'm, or if I want, if you
Yeah.
even want, actually you have to pay me more because
Yeah.
taxation is much less in Singapore. So
Yeah.
post tax, even if you pay me what I'm making, I'm losing money.
Mm-hmm.
So why on earth would I come back?
Yeah.
So that aspect is very true, where some of your best talent is still going to just seek global housing. Then if they can't be in the US, they're going to push for Europe, they're going to push for Canada, for Dubai, for Australia. But this is going to the best talent. This is going to be last on their radar
But
because India
wouldn't
pay
a
scales.
local yeah, wouldn't a local Indian corporates be like, oh, this is a great opportunity, we should seize this
They
and
will, but
find a way pay.
but our country just can't support those pay scales. So the local corporates will make offers, but those offers will be at for 30, 40, maybe 50% of what these folks used to make. So
Okay.
that's number one. The
Mm,
second part is that we don't have the room to absorb that much talent.
mm,
There's a reason why India has a huge immigration flow. It's because we don't have that level of domestic job creation yet. I mean, hell, that's something that we as startup investors are banking on, which we can create. But it's not going to be created overnight. It's not going to be
mhm.
created to absorb these people next year. It's going to take a decade to create that level of those new employment opportunities. It cannot happen tomorrow.
Yeah.
So that's my view on the too much exuberance on the positive. That being said, and on the negative, I think that a lot of Indians are going to stop looking at the US as an educational hub, because most people go there with the education mindset of I will stay. There's a
Yeah.
certain few who go there with the notion of I want to get that education and then come back. But a large amount of people take that education opportunity with the mindset of staying. So I think that the US is now going to drop significantly as an educational hub, which they're looking at, which is just going to be net sad for the world. Because some of the
Mhm.
best inventions, the
Yeah.
best discoveries, the craziest things have come out of immigrants who have
Yep.
settled. I mean, my favorite, I put up a LinkedIn post on this recently. Bose, the company is actually founded by an Indian. He's an American Indian, was born in the US to an immigrant family, but he studied at MIT.
Mm-hmm.
And then built Bose, the company. And what a lot of people don't know is he then gifted Bose to MIT, a large
Wow.
chunk of shareholding. So MIT
Yeah.
holds a large chunk of the shareholding of Bose, which makes, I mean, some of the best audio in the world. And that
Mm-hmm.
was created by the magic of an immigrant in the
Mm-hmm.
US, with the US education system and the support being able to create there. That magic is going to be lost. So
Yeah.
it's a net negative for the world,
Yeah. But it's
which
going
is
to be a
sad.
long-term kind of, I guess,
Yeah,
attrition
no,
if this
very,
continues.
very, very early. Um, and on as an investor, I definitely get a little happy, because let's say there will be people who come back, and out of those people who come back, there will be people who say we're going to build. So
Yeah.
I view like experienced. There will be a net increase in experienced potential founders coming in.
But what about other markets globally that could be positioned to take advantage of this? I mean, I'm guessing UAE will be one of those markets that will be positioned to kind of capture some of that global talent. But are there any other markets that you think that may be poised to take advantage of this flow
Not
of
the
talent?
sheer number, just can't absorb the sheer number. It's going to kind of get spread across all over, where there are a lot of folks who'd also come back, because
Mhm.
being on the H1-B, being with the pressures that kind of Trump has been putting down now, like it's scary, where you're waking up and you don't know whether you can continue living in the country tomorrow. So there are folks, I definitely, and I know I've been speaking to some friends who just are contemplating that, hey, you know what, we are qualified enough to get a great job when we come back, if we come back. And
Mhm.
it'll be really nice to just be able to wake up in the morning without worrying that I'm going to be thrown out of the country.
Yeah. But how open are these people to coming back to build in India, live in India again? I mean, the lifestyle in the US and the lifestyle in India is very
It's
different,
it's
right?
a huge adjustment period. I think it's going to be really hard. And what I really hope, and this is again the hopeful side of me, I don't know whether it's going to pan out, is that this could kind of force India to change and grow up faster. Where we do have a lot of bad habits, both as people, both as a country, and I really
Mhm.
hope that this can help us shed some of those habits faster. Where you've got folks who are coming back who are used to being rule abiding, who are used to following kind of rules,
Mhm.
both from a governmental standpoint as well as like a in your vicinity standpoint.
Mm.
So maybe that could be kind of a net positive change.
Do you see a lot of Indians moving to UAE still? Or
Yeah.
among your friends, are they, I mean, okay, I mean, I feel like, I mean, me being in the UAE for the last year as well, I think there's a lot of stuff that goes on to the news about UAE, there's a lot of talent. I think it is true. It is attracting a lot of global talent, but there are also different tiers of talent as well. And I think that a lot of it is still kind of evolving as we speak. There has always been historically a UAE India corridor. But yeah, I don't know among your circles whether or not those
There's a lot of
people
movement.
actually
So
still want
so
to
I,
come
for
back.
example, I grew up in Oman, which is kind of the
Mm,
neighbor of the UAE below in
mm,
Muscat. My parents were there for about 37 years. So I've seen like the Indian diaspora, been traveling. We used to travel to Dubai frequently. And I think that why people are going there is, and there are a couple of things that India just needs to do to capitalize completely on the opportunities that we have.
mm,
Number one is just fixed tax, um, fixed taxation. The taxation is just way too high and being borne by a too small amount of people. I don't know if you know this, but less than 6.5% of India files tax, and close to 4% actually pays income tax.
mm.
So your personal income tax burden is effectively being borne by 4% or under 4% of the population.
Wow.
The indirect taxation, they've made a move to correct it now, which is great. But the indirect taxation until now was GST, was most things sat in the 18 to 28%. Most things that you or me would buy. Unfortunately, yes, it's called luxury, but you're taxing me at 18 or 28%. So
Mm.
not only am I being taxed over 30% on my income, I'm then being taxed close to a blended 20% indirect. So I'm effectively paying almost 50% of my income in taxes in
Mm-hmm.
return for no healthcare,
Mm-hmm.
virtually no healthcare. Like if you step into a really like average government hospital, you would just be like, I'd get sick if I step in. So
Okay.
no healthcare. Um, but no safety net. There is no
Yeah.
safety net. If you get unemployed, unless you've set up your unless you put money into the government pension fund, which also has a lot of cutoffs, there is no safety net. You are not going to get there is no unemployment benefits.
Yeah.
At
Yeah.
least not that cover any of our kind of incomes.
Mhm.
You'd be given maybe about $4 a day. Yeah, that's not making a difference in our life.
Yeah.
So you're paying this kind of tax, like European level tax, where you're getting horrible air to breathe,
Mm-hmm.
terrible roads to drive on.
Mm-hmm.
Public education is again inadequate. So almost everyone who can afford it, including a lot of people who can't afford it,
Mm-hmm.
send their kids to private education.
Mm.
So the question is, yes, tax is something that you pay, but the question is always, what are you getting for it?
Yeah.
And the answer is very clearly nothing.
Yeah.
So that answer drives a lot of people to say, hey, I'd much rather just go somewhere where that doesn't exist.
Okay, I know last question, but if you were an Indian founder today and you had this opportunity to build from anywhere in the world, let's say you can't do it in the US, do you think an India founder would do it in Europe, in UAE, or in Australia or Singapore? Like where among these jurisdictions do you think
If
would
it's a
be,
global software company,
yeah.
I
I can
think in
only think of Europe. Yeah, literally Europe, UAE, Singapore,
I
Australia.
think in the
I
early
don't know if there's
stages you
anywhere
have
else.
to build it from India, and you in the early stages because
Okay.
Singapore or Dubai are very expensive for early stage life.
True, true,
Too
true.
expensive for early stage life.
Yeah.
That same $1 million will last you maybe 8 months in Singapore, 10 months, maybe a year in Singapore, but you can
Mm-hmm.
drag that to 2.5 years in India.
Mm-hmm. Yeah.
So um, I would definitely, as an early stage founder, still build here.
Mm-hmm.
Um, I don't know about the answer of the answer of whether I would then shift would be very, very dependent on how policies shape up over the next few years. I'm pushing very heavily for some changes and like hope that they happen. Um,
Interesting. Okay. All right. Okay, cool. Yeah, I think we've come to the end of the podcast. We had a really good session today, but
yeah,
thank you for joining me.
thanks, Kristie.
Hope
Fun.
you should definitely come back again soon. Um, yeah. So I think we'll wrap this up. Thank you, and I'll see you soon.
Thank you.
Yeah.
Looking forward.